So, good afternoon to everyone. On the behalf of Auditing and Assurance Standard Board of ICI, I extend a warm welcome to all of you at today's webinar on SA 540, that is on auditing accounting estimates, including fair value accounting estimates and related disclosure. As you know that SA 540 is one of the most critical and judgment-intensive standards as it deals with the areas involving management estimates, assumptions, and fair value measurements. And that matters require professional skepticism and sound judgment by the auditors. The objective of today's webinar is to deepen our understanding of how auditor can effectively evaluate management estimates and respond to the risk of material misstatements. For this webinar, we are privileged to have with us CA Niranjan Paul, an eminent speaker and experienced professional. So, good afternoon, sir, and welcome at today's webinar, sir.
Thank you, Vivek.
So now I would like to introduce our speaker, CA Niranjan Paul. Is a partner at MSKC Associates LLP, and he has deep experience in corporate laws, financial reporting, and complex auditing matters. He worked closely with the audit committee and boards to implement best-in-class practice in disclosure, transparency, and financial integrity. He is associated with the various capacity building bodies like Indian Corporate Law Services, set up by the Ministry of Corporate Affairs. He is also a special invitee to Auditing and Assurance Standard Board of ICAI. He provides point of view on emerging topics in leading publications, having national presence, and is a speaker at various forums. Apart from the profession, CA Niranjan Paul, so CA Niranjan Paul is a photographer who enjoy capturing wildlife and nature through the lens, a creative outlet that complement his analytical edge. So now I would like to request CA Niranjan Paul sir to start this session. Thank you.
Thank you, Vivek, and thank you, ICI, for having me here. It is great to be able to speak to fellow professionals and share our insights. Uh, there are some thoughts which I have put it up on the slide, and will take you through the slide. We'll be spending around 2 hours together, and we thought that uh, it is important that we keep the conversation rolling. So please put on your questions through the chat box, and I'll be happy to take it forward. Right. But I think Vivek laid the context quite well. Accounting estimates and disclosures is a very critical area, especially from an auditing standpoint, and also equally from the management standpoint. And we'll try to look at the nuances uh, in this 2 hours or so. So, what we'll do today is that we'll have a quick recap of the standard. There would also be a case study, which wherein I will try to explain the expectation and the mindset in which the auditors would need to look at estimates, and lastly, then we'll close it with some key takeaways. Right. Accounting estimates, I think, though it is quite well understood, but just to start off and from a context standpoint, every financial statements today that you prepare under accounting standards, or you prepare under Ind AS, or a non-corporate or a non-company entity, there would be some level of estimation that is involved. So making estimation is inevitable part of preparing financial statements. The degree of estimation might vary based on an entity or based on the accounting framework that you are following. So the estimates could range from routine matters like provision for expenses, or maybe some more challenging matters, right? For example, fair valuation and many of the complex items that you might find on the financial statements. But whether it is a complicated or a complex kind of estimate, or it is a simple or a routine estimate, One thing that is very common in any estimate is that they attempt to look into the future. So you look at the evidence that you have today and you try to predict what would be the likely value of a particular financial line item, right? So be it AS, be it INDES, or any other framework, the inherent nature of estimate is to predict or to look at future. Now, the degree of estimation uncertainty, it affects the risk of misstatement. So, for example, if it is a complex kind of estimate, then the possibility of having a risk of material misstatement obviously goes up. Now, that also is somehow linked with if with management bias, and we'll talk about management bias. But at least to start off, to the degree of material misstatement which Vivek mentioned is linked with the complexity and is also linked with the bias which management may have in a particular estimate. Now, objectives of accounting estimates or the standard of auditing SA 540 are very clear. The objective is that you derive the estimate based on the applicable financial framework and the financial statement line item. So, why is it important? Is that even though we're talking about estimates in general, the accounting framework might have different nuances when you have to estimate a particular item. So, for example, a provision for warranty, the estimation or the accounting framework that is applicable might be very different if you have to talk about realizability of deferred tax assets, right? But we're trying to talk about estimates in general. But a very important point to start is that the estimates might vary depending on the applicable accounting framework and also depending on the financial statement line item. The other objective, I think we somehow spoke of futuristic kind of a view. Accounting estimates forecast the outcome of one or more transactions, right? Because you may not have a precise means of measure, but they would try to forecast the outcome of a transaction or an event. Uh, the whether if there is a difference between the accounting estimate and the original amount, if the difference is huge, can you say that the financial statements were materially misstated? We don't think that only because you have a difference that makes the estimation process incorrect. The process is to make certain estimations. They are not uh, trying to find out a very precise kind of amount, but they are trying to base or predict the amount based on particular inputs, right? But we should be conscious if there are significant differences between the estimates and the final amount that will fructify, right? So, what is accounting estimate? I think the standards on auditing clearly lays that down. SA 540 specifies that an accounting estimate is an approximation of monetary amount. There is an absence of precise means of measurement, and if the amount is measured at fair value, there would be an estimation uncertainty, or there could be other amounts that require estimation. So, in a very nutshell, accounting estimate is approximation of a monetary amount where you don't have a precise means of measurement, right? And how different is that from an assumption? Whether accounting estimate and assumption both are synonymous or they are different. So, as far as the auditing is concerned, and to some extent the accounting phenomena also, there is a close relationship between an accounting estimate and an accounting assumption, right? So they are both are not alternate to each other. Uh, Again, from a summary standpoint, assumptions are inputs that drive a number, right? So if you have to make certain assumptions, a particular growth rate or a forfeiture, that is an input to a particular computation. So estimate is the end product. When you put all these inputs together, finalize your mathematical computation, you arrive out a predictive amount. So estimate is that amount. Now, how you're deriving that estimate is where the assumption comes into place. But in many of our conversations, what we felt is that this differentiation between estimate and assumption is quite relevant, because there had been certain concerns which we have noted. Right. Examples of accounting estimates, there could be many, but some of the commonly used accounting estimates are there on the slide. Inventory obsolescence, whether the inventory would go back, or whether there is another way to realize the carrying value of inventories existing as of the reporting date. Depreciation of property, plant, and equipment. If you have a continuous process plant, what would be your depreciable life, or your useful life could be very different as compared to a plant and machinery which is working on a single shift basis. So again, determination of useful life can, in certain scenario, be a very complex kind of accounting estimate. Financial instruments, considering its inherent complexity, debt equity classification, embedded derivatives, or year-end valuation of a financial liability might have certain challenges. Expected credit loss, because we under Ind AS would follow a expected loss model as opposed to an incurred loss model. The model inherently depends on forward-looking information, and hence that becomes an accounting estimate. A warranty obligation or outcome of pending litigation. Again, we're trying to crystal gaze what will happen in future. So, since these are based on forward-looking data or assumptions, they would also qualify as an accounting estimate. Uh, how is an accounting estimate different from accounting policy? Though that could be a separate accounting topic, but briefly, what our session today will only focus on accounting estimate. We will not talk about accounting policy, but we thought just to briefly highlight and to get the context clear, accounting policy are the principles or basis based on which you prepare your financial statements. Accounting estimates is an estimation of an amount. So policy is more like a principle or a concept. Accounting estimate is more like an approximation of an amount. And the way you recognize a change of accounting estimate is very different how you apply a change of accounting policy, right? But as I said, our focus of today is only accounting estimates. We are not going to talk about accounting policy. What does the applicable laws and regulations says? So, for example, under the Companies Act 2013, the directors in their board report has to specifically mention that the accounting policies and the judgments and estimates that they have applied are reasonable and prudent to give a true and fair view. So, what we want to highlight is that this is not just an accounting kind of a requirement. The directors in their board report have to assert very, very clearly whether the judgments and estimates that they've made that is capable of giving a true and fair view, right? Let's talk about audit committees. Under SEBI listing regulations, the responsibility of the audit committee is to review major accounting entries involving estimate. So, what we only urge you to not just limit your understanding or assessment to an accounting kind of a framework, but in this slide, what we're trying to highlight is that even from an applicable laws and regulation perspective, accounting estimate has its footprint, be it the Companies Act 2013 or the SEBI listing regulations, right? So when we talk about representations, or when we're talking about the views of the management, this two data points, the board of directors report or the audit committee minutes of the meeting, could also help the auditor to have a much more better understanding on the board of directors and audit committee's view on complex estimates, and measurements. Right. Uh, Before we get into the auditing part, what I thought we should be discussing is that why auditing accounting estimates is so challenging. So we have certain reasons why we believe that they are so challenging. But if you would see on the slide, there is a significant amount of regulatory scrutiny, right? There are, since it is a judgmental matter, both would try to look at a particular set of assumption or a particular set of data point from their perspective. And regulators in the inspections worldwide have also seen is that this is the accounting estimates is also a very fertile ground for financial misstatements, right? Be it understatement of liability or be it blessing the recoverability of a particular asset that have been very closely identified and flagged off as a spotlight area by regulator. Judgments, they are, we as auditors would take significant judgment calls when we're talking about auditing estimates, right? But let's see the first reason, right? So unlike auditing past transactions, what we generally do in case of audit, auditing estimates is about the future, right? It's like looking at the crystal ball, and then we're trying to predict or forecast about the future. So, as we said, that it is a forward-looking information, and that's the reason it is difficult to arrive out a precise amount. So it is more like looking at a crystal ball and auditing. Yeah, prone to bias. I think this is the biggest area where regulators focus on how did the auditors mitigate the risk of management bias. Now, since the assumptions are prepared by the management has significant discretion in the assumption they apply in making accounting estimates. For example, it could include growth rates, discount rates, determination of useful life of property, plant, and equipment, or any other estimates. Now, there is always a risk of intentional bias, right? Which is to manage the earnings, or unconscious bias about being very very optimistic. But you would hear me talking about management bias later also. But the estimates, they are susceptible to significant amount of management bias, right? Disruptive landscape, right? We are going through a disruptive economic environment. The global economic environment is also not very positive, and hence there could be retaliatory tariffs, supply chain issues. These magnifies the subjectivity, volatility, and uncertainty inherent in accounting estimates. So if the overall business environment itself is disruptive, the ability to have a much more better accounting estimate, that also reduces. We also have data quality dilemmas, right? Data quality, as we know, is at the heart of auditing accounting estimates. Even if models and assumptions are appropriate, if the data quality is poor, it would mean that the estimates itself unreliable. We also have a black box problem, right? Simply put, there are many modern estimates which are very, very complex, and they are very model driven. So you would put some input in a particular model, be it a Blackstone-Scholes model for employee share-based payments, but you may not be very clear on how this model works, right? So you might be feeding in data, the model will churn out a particular outcome. But if you have to link the input with the output, that somehow becomes very, very problematic. Now, what we also see is that when we are using a model, there are people or entities who would be using digital tools like AI to generate an understanding of the future. Now, as far as the auditors is concerned, these models and technologies operate like a black box. The data goes in and the result comes out, but the internal computations are not verifiable. So again, that creates a challenge in regulatory scrutiny, especially to demonstrate how the inputs had led to a particular output. Lastly, time pressures, right? Estimates like impairment are usually finalized at the period end close, right? Leaving auditors very less time to challenge accounting assumptions. So the time pressures on these critical estimates somehow reduces skepticism and then increases the risk of oversight. So this particular slide, we are trying to sum up why the accounting estimate is so difficult uh, and so challenging. My only submission to all of you is that considering the heightened regulatory scrutiny, disruptive landscape, and the multiplicity of judgments that the auditors make, the the auditing of estimates would require a significant effort from very senior persons from an engagement team, right? So when we're planning a particular engagement, I think we should be conscious of these complexities and frame our audit plan and audit strategy accordingly. So what does the auditing standard 540 say, right? In this slide, what we're trying to summarize is the overall approach. If you would look at SA 540, the auditor's response is graded, right? If we say it is a normal kind of a risk, then the expectation from the standard is quite different as compared to identification of a significant risk in a particular estimate. So it is more like a graded response. The more complicated or the more complex the estimation process is, the more rigor the SA 540 would require the auditor to exercise. Significant risk, which could also include fraud risk, is the one which the auditor judges to have a very high estimation uncertainty. Now, the size of item in the draft financial statement may give a very misleading view of its potential significance, right? So if you have been given a draft financial statements based on which you will audit a particular entity, if there are estimates that have not been done correctly, so the identification of risk or the identification of material financial statement captions may not have been done appropriately. If an item is estimated to have a low value but is subject to high estimation uncertainty, then that figure may be significantly understated as compared to the eventual outcome of the estimate. To deal with this, what the expectation under SA 540 is to use the draft financial statement as a starting point, right? And these are just the planning stage discussions. They are not the final stage identification of estimates. So whenever we have been provided with a draft financial statements, we should be using this for our planning purpose. And as and when we progress in the audit, when we get the final financial statements, you might be able to identify other material captions on financial or an accounting estimate. Now, what SA 540 also highlights is that the greater the estimation uncertainty, the greater the amount of evidence the auditor would need. And it is not dependent on the size in the draft financial statements. It is the inherent nature or complexity of the accounting estimate that is important, rather than to say that these are immaterial and hence they do not require adequate consideration. So when we look at a number from a draft financial statements, what we would like to urge to all of you to look not only at a quantitative threshold for your materiality purpose, but also look at the qualitative features of a particular accounting estimate, right? And if there is a greater estimation uncertainty, even for a low value item, we would expect all of you to go back and question the determination of material items. It is quite possible that because of this complexity, these are qualitatively material. Yeah. Uh, Now, like in any audit, since we follow a risk-based audit, if you're auditing an accounting estimate, the first process would be to perform a risk assessment. Now, under the standards on auditing 540, the auditors would require to obtain an understanding of the entity, which would be the first step for risk assessment procedures in this particular order, right? The auditor should verify what is the applicable financial reporting framework, right? Be it AS, be it Ind AS, or be it the non-corporate or non-company entities. What is it that governs the preparation of financial statement? That understanding is quite important. The next step would be to understand how management identifies transactions, events, and condition that may give rise to an accounting estimate or a disclosure of an accounting estimate in the financial statements. So first we understood the applicable framework, then we understood the management process, how they are trying to identify a particular set of transaction or event and calling them as accounting estimate. Third and the last step would be to understand how management is making accounting estimate, right? And also understand what are the inputs, data, or the assumptions that they're going to use to compute a accounting estimate. Now, when we're talking about management's identification and its understanding by the auditor, auditor would expected is expected to inquire about changes in circumstances that may give rise to new estimates or revise accounting estimates. So we might be a bit tilted that we carry forward our understanding from last year, but from a SA 540 perspective, the auditor would also need to cross check whether the understanding that we have obtained in the previous year that continues or there has been a change. If there is a change, the auditor should check and inquire again whether there is a new accounting estimate or there is a reason to revise existing accounting estimates. Uh, to understand how management is making estimates and its process, SF 540 would expect the auditor to understand the method, the model used, the relevant internal controls, whether there is an engagement of an expert by the management, the assumptions that they have used, and if there is a change from the previous period. Yeah. Moving on to other items of risk assessment process, the auditor is also expected to review the outcome of accounting estimates included in the prior period financial statements. So, technically speaking, this is known as a retrospective review of accounting estimates. But this also is very important for the auditor to cross-check the appropriateness and adequacy of the management process of deriving estimate. If the final amount of outcome is very close to the amount that we have estimated in the previous year, then it only reiterates the robustness of the internal controls and the estimation process, right? The auditor should also require to reassess subsequently the accounting estimates, whether the amount would undergo a change basis the facts and circumstances applicable today. Now, if the review of these estimates uh, is not intended to call question the judgments made in the prior period, but are based on the information available at this point in time. So these particular steps of retrospective review of accounting estimates or subsequent re-estimation of carry forward estimates, the idea is to not to question the assumptions and the estimates that we have made in the past. Because if we do so, then we will be applying hindsight in developing an accounting estimate. Accounting estimate is a as of date computation, So if the management would have used the relevant information as of a particular date, it is quite possible those information or data undergoes change subsequently, right? Now, only because we are trying to re-estimate the number today, that doesn't mean my previous estimate was wrong, right? So we thought we'll just highlight that in the risk assessment process, we might need to go back and recheck our previously audited accounting estimates. And if the estimation data changes, the outcome would change. But that doesn't mean my previous estimation was inappropriate. The other sort of inquiries which an auditor might be expected to do is to inquire about new type of transactions that may give to an accounting estimates. So, for example, if I am in the previous year was selling only goods, but now in the current year I am bundling goods and services, then probably under the accounting framework, I would have to estimate and split the portion of goods and the portion of services from your purchase or sales consideration, right? So if there is a new set of transaction which the entity is involving, the auditor would be expected to inquire whether because of this new businesses or new type of transactions, a new accounting estimate is triggered. Now, the transactions could have continued, but whether the terms that give rise to a transaction has undergone a change. An example which I could think is that I might, from the current year, extend an additional credit period for a particular trade receivable. So, if that is the case, my terms of sale have undergone a change. Uh, if my terms have undergone a change, the auditor would need to inquire whether this change of terms would result in a new or a revised accounting estimate. What about changes of accounting policies, right? So let's say there's a new standard which has been incorporated in the current year, or there are revisions to the existing standards. Whether these revisions or a new standard trigger a new accounting estimate is what the auditor would need to inquire. There might be regulatory changes. So, for example, if you would see, the RBI has issued a draft paper or a draft consultation paper on using the ECL model for banks. Now, that is a regulatory change or a expected regulatory change. If this change would get notified, will this also require the auditor to check the level of estimation and the controls? That is inquiry which an auditor is expected to carry out. Uh, the auditor would also be expected to understand the applicable accounting framework. As we said, generally it would be Ind AS accounting standards or any other ICAI guidance notes, for example, non-corporate entities or non-company entities, right? Those could be some accounting frameworks which the uh, auditor might inquire with the management to reiterate its uh, continued use. Management bias. I think we started our discussion with management bias, but what it effectively means is that whether there is a lack of a neutrality in preparation and presentation of financial statements. So bias generally means that your outcome is not your process is not objective. It is tilted towards a particular outcome. You desire an outcome, and hence you find means and ways and data points to justify that assumption. So that's a bias because there's a bias to reach or to have a particular outcome. Uh, as we said, it is inherent in the estimation process, and since it is a very critical item in my estimation process, the standard have also laid down certain indicators for the auditor to identify whether there is a material management bias or not. So some of those indicators are there on the slides. So for example, an indicators could be that change in accounting estimate or the method of making it, where the management has made subjective assessment that has changed from the current as compared to the previous year, right? Whether the entity's assumption is based on a well recognized model, or it is more like a proprietary model which the entity would use. If it is like if it is like a globally acknowledged model, or a marketplace acknowledged model, for example, a Blackstone Scholes model for ESOP cost, then possibly the level of management bias will be lesser as compared to a proprietary model for that have been developed by the entity. Another indicator could be the selection or construction of significant assumptions that yield a point estimate that is favorable towards management's objective. So, in this indicator, the management would actually work backwards. They want, or they would desire a particular outcome, and they would find means and ways and other data points to justify the existence of management bias. Now, selection of a point estimate that may indicate an pattern of optimism or pessimism, right? We generally hear that we want to be conservative in our accounting estimates and accounting computation of amount. But if you're utterly conservative or overly optimistic, both are indicative of management bias. As we said in the previous slides, the expectation from the board of directors is to assert that these assumptions give a true and fair view. So if the assumptions are utterly optimistic or pessimistic, then obviously the financial statements will not give a true and fair view. So the management bias assessment and its inquiry thereof by the auditor is very important consideration from estimation perspective under SA 540. Understanding accounting estimates, right? Quite naturally, the auditor would understand the types of accounts or transaction which leads to accounting estimate. It might be a revenue item, it might be expenditure item, it might be an asset item, or it might be a liability. It might also include disclosures, right? So, for example, if you have to disclose the outcome of a particular litigation in the financial statements under the applicable accounting framework, the disclosure and the extent of disclosure might require a judgment, right? Whether the management has used recognized measurement techniques or not, that could be an important criteria for for the auditor to understand. Now, what if the management is providing an interim set of data, right? So, for example, when we are looking at the estimation of employee benefits, which are determined based on actuarial basis, if the data that has been sent to the actuary is based on an interim data, the auditor should check how different, how close that data is to the year-end cutoff date. If it is too large, then possibly the data that has gone for actual valuation would be quite different. So an important area, and generally it is overlooked. The auditor would need to understand the point in time in which the data is used by the management to develop an estimate. If it is an interim kind of a data, the auditor should take a note and should assess the difference between the interim data as well as the data as of the reporting period. Understanding of control, absolutely critical. And if you would look at the guidance note on internal financial controls, also the rigor that you would need to apply on understanding relevant controls is quite important, because unless you have the process right, uh, the outcome we can be very sure of would not be reliable, right? So the standards on auditing 540 would require the auditor to understand the relevant control, and they would require the auditor to understand how management determines the completeness, relevance, and accuracy of the data that is used to develop the estimate. The auditor should also understand the accounting estimates, including the assumptions, inputs that have been appropriately approved, right? So, is there is a segregation of duty, or the way the management would extract relevant information from the financial statements, or its financial framework, that whether that have been approved by competent person, right? The auditor would also understand the controls around segregation of duties between the entities who is working on or committing the entity to a transaction versus who is responsible for making estimates. If there is a segregation of duty or not, is what the auditor would need to understand. What are other peripheral or other relevant controls that have been established over the accounting estimates? For example, design and development of a particular selection or of a particular model, controls around use of a model, maintenance of periodic validation of the integrity of the model. So, one control that I could see from an IT standpoint, whether the general IT controls on that particular model is appropriate or not. If the IT controls have failed, then possibly the auditor would need to look at mitigating controls, be it physical, be it manual or electronic, to see whether there is a possibility of material misstatements in that context. Significant risk exist in high estimation uncertainty. The auditor would also need to see whether, because of this significant risk, there is a risk of fraud, right? The auditor would need to obtain understanding of entity's control, the control environment. They would need to perform a retrospective review of management judgments and estimate. They would need to perform design procedures for biases that represent a risk of material misstatement, especially due to fraud and management of right of control. Practically, what we have also seen is that the auditor's review of prior period accounting estimate as a risk assessment procedure may be carried out in accordance with SA 240. Now, 240, as we know, is a auditing standard on fraud, and fraud as a concept might be there when a management is making an accounting estimate. So, if there are triggers which the auditors have identified during the risk assessment procedure, of a possible fraud, the auditor would also need to consider the requirements of SA 240. So what we're trying to highlight is that the estimation is a very, very wide topic. It might spread across multiple auditing standards. So our sincere request to all of you would be not to use or read the standard in isolation, but also to consider the relevant requirements under other auditing standards, especially where there is a possibility of fraud, where the auditor would have identified based on its understanding of the entity and its control environment. Uh, Whether the management has involved a particular expert is what the auditor would also need to inquire and understand. Now, there could be specialized nature of estimation. For example, in the field of oil and gas, you would need to estimate the oil in a particular rig or in a particular well, right? That requires a very, very significant and complex estimation process. Generally, we have seen that these complex estimation require involvement of management expert. Uh, the auditor would also need to understand the technical nature of the model, right? Is it that something that they have an experience with, or it is too much sectoral specific? So, for example, if you have to look at the actuarial valuation of insurance policies of an insurance entity, that would be very, very tricky and very, very complicated in that sense. So the technical nature, whether the expert employed by the management have significant or sufficient competence and objectivity to perform these kind of an estimation, is also an important consideration for the auditor. If the item or the transaction or which is being estimated is unusual or infrequent, then the management might need to involve a particular accounting estimate. Instantly, what I could think of is, let's say, a business combination or an amalgamation has been done, and there is uh, a expectation to derive the fair value of the purchase consideration. Right? That could be an infrequent kind of a transaction, and if it is infrequent, then the management might like to involve an expert. But what we will also like to highlight is that where the management expert has been involved, auditor would need to assess the competence and objectivity. They cannot and they should not blindly rely on the work of management expert. They should assess the competence and objectivity of the management expert. Now, when we talk about competence that doesn't mean that you are you have a degree or you have a particular level of qualification to a particular model or a particular estimation. The expectation of the standards and in auditing is is that the auditor should look at the competence. So whether, for example, in the hydrocarbon example which I gave, whether the person who is involved in estimating the reserves of oil and gas, whether he or she has appropriate experience in that particular sector. So we are talking about sectoral subject matter expertise, uh, uh, and their involvement in making an accounting estimate. Uh, and I would like to reiterate is that qualification is not akin to competence. We're talking about competence as an experience of that person on a particular topic. He or she may be well qualified to perform an estimation, but whether they have enough experience and whether they have a background, that will make them competent to perform the accounting estimates. So before we move on, a very important criteria or a thought I want to leave with all of you is that for management experts, the auditor continues to remain responsible. We cannot say that we are relying on the work of somebody else blindly. We have to perform procedures and assess its appropriateness before we choose to rely or use the work of management expert. Uh, we are moving on to estimation uncertainty, and the auditor would also need to understand the estimation, the management assessment regarding the estimation uncertainty. So, the standards on auditing would expect the auditor to verify how management has considered alternative assumptions or outcomes. So, if it is an estimation that is very complex or the estimation uncertainty is quite high, then the auditor would ask the management uh, whether they have looked at alternate assumptions or alternate data points or alternate outcomes. So what the standard on auditing is expecting the auditor is to look at sensitivity analysis or a scenario analysis. So if it is scenario A, what is the outcome? If it is scenario B, whether what is the outcome? Now, how did the management rule out scenario B, and they have opted to choose scenario A, right? So that is a very important requirement from an auditing standard perspective, where the auditor was required to verify whether the management has ruled out alternate options or alternate outcomes. We talked about scenario planning. The auditor would also need to see whether the accounting estimates and its analysis indicate a number of scenarios. You might have a range of possible scenarios when you are developing an estimate, whether the management has considered all the possible ranges when they are developing a complex accounting estimate. Whether the management monitors the accounting estimates made in the prior period. So, what are the follow-on from those estimates, whether those estimates would require a revision or those estimates are good to go from a data point as of today, is what the management should assess and the auditor should equally verify. Another important consideration, the auditor should verify whether the management has appropriately responded to outcome of that monitoring procedure. So if the monitoring procedures employed by the management has identified any deviations, how those deviations have been looked at while making estimates of the current year. When we're looking about the monitoring and the deficiencies identified uh, as compared to the previous estimate, the auditor should also be cognizant of the prior period error standard from an accounting standpoint. If these represent an accounting error or a prior period error, the auditor would need to also verify that whether appropriate disclosures as per the applicable accounting framework has been carried on by the management or not. Use of model. I think where the auditor would need to evaluate the use of the model, whether the model that is being used by the management is appropriate in a particular circumstances. So, for example, in an ESOP, the guidance note on employee share-based payments permits the management to use the intrinsic value method or the fair value method. If the management has used a particular model to verify its intrinsic model, whether the intrinsic value is determined by that model appropriately, or there could be other models which the management should have used. So, not, in a nutshell, what we're trying to ask is that how does the management verify that this is the model that they should be using? How are they ruling out other possible models? So, for example, the nature of the entity could be that it is working in a particular environment or a particular industry or a specific asset or liability that is measured. And if there are multiple models that are available, what was management's rationale for choosing one particular model is the important criteria for the auditor while evaluating the accounting estimates. Whether the model is commercially available for use or if it is a proprietary model. So, if the management is using a proprietary model, then the auditor would need to be more conscious about uh, the robustness or the appropriateness of that model as compared to a commercially available model. For example, if you're using a discounted cash flow method through a fair value model, then that could be a very well acknowledged and well researched kind of a framework or a model. If that is used, then probably the concerns around validity and appropriateness of outcome would be lesser. Whether the management expert has been involved to develop and test a particular model. If yes, then the auditor would also need to understand the considerations or the deviations which the management expert have observed while evaluating a particular accounting model. Whether there were validations of model prior to its use. For example, did the management verify the soundness of the model and its integrity? Consistency and completeness of inputs with market practices, right? Output versus actual transactions. So again, what has been estimated versus what has ultimately been recorded. How close is that? Are those two numbers could be an important consideration in evaluating the use of an model. Now, if there has been a change in a particular control policy and a procedure, whether there are proper approval mechanism or there is a control policy to see whether the controls have been made appropriately. Uh, Whether the model is also particularly calibrated. So, for example, I might be using version 1 of a particular model. Now, the version 2 are also being used very frequently in various industries or in the marketplace. So, why did the management chose to continue with the version 1 of the model? We should also be checking as an auditor whether these models are calibrated and brought up to speed with the recent developments. While evaluating the model, the auditor may need to check the adjustments to the output of the model to reflect the assumptions in the marketplace participants would be in similar circumstances, right? So under IFRS 13 or in DAS 113, we would be using a market participant approach to determine the fair value, right? Now, One of the important item which the auditor should verify is that whether after the output has been derived, whether we are making some adjustments to that model to derive the fair value as per the applicable accounting standards. Uh, and also importantly, the auditor would need to verify whether the model is appropriately documented. If there is a SOP or a detailed set of information which the entity is retaining with them when they are trying to evaluate the appropriateness of a particular model. Moving on to assumptions, what the auditor would need to consider whether the individual assumptions appear reasonable. So, for example, if I am going to take a 20% growth rate for a particular class of business, is this reasonable with the growth rate of that particular industry or the particular sector or the particular country, right? Um, and if it is way different, then there would be doubt on the reasonableness of the individual assumptions of the accounting estimates. Inter se consistency of accounting assumptions are also relevant. So if I'm using a particular growth rate for my cash flows for impairment assessment, shouldn't the same growth rate be used when we're looking at the going concern assessment of a particular entity? So if the auditor is having multiple accounting estimations, um, the interdependentness or the consistency of these accounting estimations is quite important and they should be ensured by the auditor. Uh, Now, when you have made a particular set of assumptions, and whether these assumptions collectively are reasonable when you apply them with other particular assumptions. So, not only individually, but assumptions as a combination and with other assumptions, how close or how reasonable they are should also be considered by the auditor. Now, as far as the fair value estimate is concerned, whether the assumptions appropriately reflect the observable marketplace assumptions. So, as we all would recall, under Ind AS 113, fair value estimates are based on market participants' approach. It is not what the management feels, but it is their understanding of how the market would be expecting a particular number, right? So in that case, the auditor should consider whether that has also been factored by the management when they are developing a particular assumption. Now, audit procedures. The idea of these audit procedures that you see on the slide is primarily to ensure consistency of information, right? So, if we would look at the uh, general domestic or economic environment, how close or how disruptive those environments are. So, in an environment where there are supply chain challenges, or whether there are retaliatory tariffs that has been imposed, or where there is a shrinkage in export market, whether these geopolitical environment or geopolitical disruptions have been factored by the management in their estimation process. That would be a very important procedure for the auditor to carry out. Now, if there are disruptions, what is the management plan to mitigate those disruptions? So, for example, if there is a particular industry which let's say was flourishing earlier, but now there is a government embargo, what is the plan of those entity to do in the near future? So, it is it a cessation of the existing business, or the entity is bound to restructure? And if it is going to be restructured or it is going to be liquidated, whether they have been factored in my estimation process or not. That should also be very clearly verified by the auditor. Assumptions made in prior period, how consistent they are. So, for example, if I'm using a 5% growth rate in the last year, should I be using a 10% growth rate in the current year, right? That That only means that we are trying to ensure consistency and verify consistency of data that have been used in the past. Again, more like a checkpoint for the auditor, or a consistency check which the auditor should do as far as the prior period data is concerned. The auditor would also need to verify the experience of previous conditions experienced by the entity. To what extent the historical information would be considered to be reflective of the future. So let's say I was growing at the rate of 10% every year because there was a very favorable market dynamics. The products of the products were very well perceived in the market, and till last year there was a significant amount of offtake of my particular product. But in the current year, we might see that the competitive edge of our product is slowly and slowly reducing. As a result of that, the overall investment climate or the competitive environment that is going against me. So if I have to look for an estimate in the current year, my assumptions and data points should be reflective of the estimate of the current year. It can't be that only because I have used a 5% growth rate of last year, I would continue with the 5% growth rate of the current year. Those estimates, assumptions, and data points should be reflective of the current year's data, right? The accounting, neither the accounting framework nor the auditing framework assumes that it would just be a carry forward of information of previous year. In the current year, those assumptions and those estimates or those data points should make sense basis the information that we have for the current year. Okay. Now, what could be other audit procedures? Right? A review of management's history of carrying out of its stated intention. So, for example, if the management has said that we will go into new business, will explore new opportunities, have the management actually done it? If they have, then probably you have a better reason to talk about or to document the intention of the management. But if the intention and the actual happening is quite different, then probably we need to have much more evidence to verify the robustness of the estimation process. There could be written plans or other documents which the auditor might need to verify. So, for example, if there is a business plan that I would now enter into a entertainment business, whether the management is actively pursuing that intention, or is it more like a tacit or a not a very active kind of a involvement. Now, to verify that, the auditor might need to look at some documentary evidence. For example, whether there are new agreements that has been discussed, whether the draft agreement is available, or whether there are term sheets which the management has entered into with bankers or other fund provider to fund this particular new set of business activity. If there are written plans and documents, that would be easier for the auditor to review and conclude on the intentions of the management. Now, the auditor would also need to inquire about the reasons for the management, why they believe that these assumptions are reasonable and they are relevant for this particular year. That would also be verified by the auditor. Subsequent events, right? I think we have talked about retrospective review of estimates in some form or the other, but not only about previous year's estimate, but also the events that has happened subsequent to the year end. Is there some messages those events are telling to the auditor, right? If the subsequent events have gone bad, whether does it amount to a adjusting event or a non-adjusting event? If it is an adjusting event, then the auditor would need to cross-check whether the assumptions and data points are reflective of these subsequent events, right? If the management has initially said that we will venture into a new line of business, but now the management is doing a U-turn subsequently, that would also trigger a need for revision in the assumptions that the management has used in the past. Uh, I think from a other audit procedure perspective, these are the top highlights which I thought I would discuss with all of you. But the review of management plan and subsequent events and documentary evidence, in my view, would be a very important evidence which the auditor would need to have in their file. Now, after the auditor have tested the management estimate, what the auditor would need to do is that they would either need to verify the point estimate, which is basically a precise amount. We're talking about a single amount, or it's a range of estimate. So what we have seen is that the range of estimates happens when you have a particular legal kind of a estimation. So we would use our permutation and combination, or the management would use its judgment to verify what are the possible outcomes of a legal litigation. So will it go to the Supreme Court? Will the opposing party would go for settlement, or whether there would be additional charge which the opposing party might levy on the management. If two or three possible options are there, then there is a range of possible outcome. Now, if there is a range, what was the management's basis to pick one of the option, or the management used an average kind of a method to find out a likely amount, right? So, as you could see on this slide, the amount or range of amounts respectively derived from audit evidence for use in management's point estimate, right? So that is what the auditor would need to verify. Now, as we know, an accounting estimate is not derived from the routine processing of data by the accounting system. There might be much more complexities that are involved. Now, auditors' review of accounting estimates made in the previous year's financial statements might suggest that the current year's process is effective, right? So if that is so, then the point of estimates or the range that the management would have find out in the past year, or they are proposing in the current year, that might be inappropriate. While looking at the point of estimate or range, the controls within an over management process for determining estimates, whether they are well designed or properly implemented or not. Now, events or transactions between the reporting period and the auditor's report date contradict management's point of estimate. I think we spoke of subsequent events quite some time back, but now we are also looking at from the auditor's standpoint. For us, it would be more from a difference between the estimation date and the date of the audit report, right? If it is a contradictory kind of a position, then the point estimate or the range estimate might also require a revision. Whether there are alternative sources of relevant data available to the auditor which can be used for making a point of estimate or a range, right? So again, these are few factors which we as auditor would need to consider when they're trying to find out a point estimate or a point of or a range. Now, a natural question could be, is that when should I make a point of estimate or a range, right? So again, there is no straight answer, and it might depend on a multiple factor, including model, the nature and extent of data available, and the estimation uncertainty in making in the accounting framework. So, for example, if you're using a commercially available model, then probably you might like to go for a point estimate kind of approach. Or if it is a proprietary model or an auditor developed model, probably it would be appropriate to look at as a range of possible outcome. Now, what are the developments? What are the management's consideration in developing alternative assumptions, for example, by introducing a separate set of assumptions. That is also an important factor for the auditor to consider whether to follow a point of estimate approach or a range kind of approach. Now, if the management is engaging or employing a specialized expertise or develop or executing a model through that expert, then then uh, then it might be appropriate for the auditor to go for a point of estimate kind of approach, making reference to other comparable conditions, transactions, or market comparable assets or liabilities. That could also help the auditor to decide whether they want to go for point of estimate approach or a range kind of approach. But whatever approach we choose, there might be a difference in perspective or difference in outcome when as compared to what the management has identified. So in that case, when the range is different from what the management has identified, what should the auditor in such a scenario do? In that scenario, the auditor would need to obtain a sufficient appropriate evidence to understand the reason for that difference. Is the reason because of differing estimates, or is it because there is a disagreement between the auditor and the management on a particular thought process, or whether the auditor's point of view is very different as compared to the management? Now, what should the auditor do? Uh, Obviously, the first step would be to understand that this information may be different, may be relevant for the auditor's development of an appropriate point of estimate or a range. Now, they might also assist in understanding and evaluating significant difference of management's point of view, right? So for example, we might see a difference between an auditor's estimate and management estimate, but both of these estimates are equally valid, right? The assumptions are equally valid. Uh, so that doesn't mean that only because of the outcome is different, somebody has to be wrong. What the standard very clearly acknowledges, that considering the forward looking information, it is possible that there could be more than one correct outcome. If that is so, then the auditor should be understanding that these estimates are highly sensitive to certain assumptions, right? So if I have to take impairment as a very simple example, it is very dependent on the discount rate that we are using, or the growth rate that we are using. If it is sensitive to a particular estimation assumption, right, then the auditor should be very careful, because because there could be more than one particular assumption, and as a result there could be more than one correct outcome, right? So it might also indicate that there is a significant estimation uncertainty, indicating that it is an uh, assumption having significant risk, right? Alternatively, a difference may arise, and that could be a result of a factual error by the management. But in a nutshell, what I would like to highlight and reiterate again, that only because the estimation of the management is materially different from the auditor, that doesn't mean that there is a misstatement, there is a material misstatement in the financial statement. As we discussed, and as we could see on the slide as an example, there could be a scenario where more than one possible outcomes would be correct. In that case, the auditor would need to look at the sensitivity of that assumption with particular estimate. Now, if we identify that because of a difference between the point of view of the auditor and point of view of the management, there is a material misstatement. Now, the auditor, what they would need to do? is that as far as estimate point is concerned, they would see whether the difference between the auditor's amount and the amount determined by the management, whether that constitutes a material misstatement. If it is below its materiality threshold, then the auditor may choose to ignore. Again, what we would like to highlight is that materiality is not just a quantitative benchmark. While evaluating misstatements, especially those relating to accounting estimates, it is important that the auditor would consider the qualitative parameters as well. Now, if there is a range of possible outcome, the then while evaluating the misstatement, the management's point estimate that lies outside the auditor's range could be a misstatement, right? Uh, In such cases, the misstatement is no less than the difference between the management's point estimates and the nearest point of the auditor's range, right? So, what we are only trying to say is that how close that management estimate is towards an auditor's estimate, whichever is the closer kind of a estimate is uh, is what they would need to consider while evaluating misstatements. Uh, let's understand what we just discussed in an hour or so through a case study, right? Because what I felt is that uh, more than having a recap, let us all experience a case study. Probably we'll be able to retain the learnings of this session in a much more better way. So let's take an example where a company sells uh, globally a low to moderately priced consumer cameras, right? There has been significant changes with an adverse effect on the entity, right? That has continued to happen over a period of time. There are newer technologies that has penetrated the market. All these have led to a significant adverse environment for the business. Now, management has identified these adverse market condition as an indicator that the carrying value of the entity's property, plant, and equipment may have an impairment trigger. And considering the accounting requirements, the management had started to determine its recoverable value. So let's see what the auditor would do, and we will for the entire audit procedures that we have spoke of in last 1 hour. We would pick up the key items of those discussions. So, for example, the first important item would be for the auditor to look at whether this assumption or this approach followed by the management is compliant with applicable gap, right? So, how the impairment model which the management is using is compliant with the gap. So the auditor might like to base the cash flow projections on reasonable and supportable assumption basis that represents management's best estimate of a range of economic conditions that exist over the remaining useful life of the asset. So if there is a PPE, or a group of assets comprising a CGU, for which the management is assessing impairment, whether the estimation of recoverable value or its cash flows are based on the conditions existing today, and they are for the remaining useful life of the CGU, right? The auditor might verify that whether the management has limited the cash flow projections based on recent financial budgets and forecasts approved by the management up to a maximum of 5 years. What we would like to remind you that under the accounting framework, there is a particular cap which the standard setters believe would be a reasonable time frame to make a forecast. As long as the forecast is within that permissible range, then the impairment model which the management have found out is would be appropriate. If it is going beyond the preferred kind of a cutoff date, then possibly the auditor would need to re-verify again whether the model is compliant with the applicable gap. The auditor would again verify whether the extrapolated forecast that do not exceed the long-term average growth rate of the product industries in which the the entity operates, right? And unless it is justified, higher rate have not been used. So as far as the growth rate is concerned, how consistent that growth rate is with the long-term average growth rate of the product or of the industry. So again, these are not auditing requirements, but these are the accounting requirements which the auditor should be considering to verify the appropriateness of this model or the compliance of this model with the gap. Now, again, from a gap perspective, whether the model or the future cash flows have been developed, including the projections for continued use of the model, uh, whether there have been cash outflows that have been appropriately considered, whether they have considered any net cash flows that is based on disposal of assets at end of the useful life. So, in a nutshell, whether the inflows have been considered, outflows have been considered, and whether the terminal value of the CGU have also been considered. Whether the model used by the management excludes cash flows from financing activities, right, or income tax receipts and payments. Again, these are specifically excluded as far as Ind AS and AS is concerned, and it is obvious that the auditor would verify whether these inputs are gap compliant or not. Discount rates, right? Whether the discount rates that has been used are pre-tax or whether a post-tax rate has been used, and whether these rates reflects a market's current assessment of time value of money and specific risks to which the asset is exposed to. Again, more of a accounting consideration, which is very well spelled out in the accounting standard on impairment. Now, revenue projections. So, what the auditor also did is to look at the projections for revenue. So, the auditor focused on management's rationale for selecting the revenue forecast used in the model. So, what the auditor did is that they challenged management as to why the selected rate was more appropriate than the available alternatives, and whether the selections of the assumptions were consistent with publicly available data. So, for example, for revenue, I am using a 10% growth rate, whether the other entities in that particular industry or previous periods or publicly available data, whether they are supportive of that particular growth rate, right? If the auditor believes that instead of 10%, probably a 8% growth rate should have been more appropriate, what was management's rationale for ruling out a 8% growth rate? So again, the focus of the auditor in this particular fact pattern was to be focused on selecting the appropriateness of revenue forecast models. Now, the auditor in this case study also analyzed historical movements in revenue and whether these remain a good indicator of likely future revenue given significant market changes and industry changes, right? So, again, it is not that the auditor carry forwarded previously obtained knowledge, but they verified whether the previously obtained knowledge is of relevance in the current facts and circumstances. The auditor also evaluated whether the entity's forecast is in line with market data, industry practices, trade publication, taking into account the reliability and reputation of that source data, right? And the auditor also verified the accuracy of management's past forecast. So if the management has made budgets and have made cash flow projections, how did those assumptions or this forecast fared as compared to an actual fructification of those numbers. That also the management verified while testing the revenue. Operating margins. So the auditor didn't just stop at revenue, but it also looked at operating margins. They compared operating margins to historical results, prior forecasts, and industry model and market data. And what they did is that they evaluated whether the actual historical margin remains a good indicator of the likely future margin rate, considering the significant adverse industry changes. So again, a retrospective review of management estimates, as well as verifying the appropriateness of assumptions that we're using for the current period. Discount rate. I think, as I said, discount rate is a very critical factor when you are assessing the impairment of particular non-current asset, be it a CGU or uh, be it uh, be it a single asset. The auditor in this particular fact pattern focused on judgments made by the management in developing and selection of a particular discount rate, right? What is the appropriate beta for calculation of cost of equity? So again, this is more of a financial modeling consideration, but beta is a very critical indicator when you are doing a forecast of the discount rate, right? The auditor also assessed in this particular fact pattern the selections made of the discount rate were consistent with the prior period and other assumptions made by the entity. And they also challenged the management to justify that key inputs selected were more appropriate than the available alternatives. The auditor also compared the discount rate with the rate used for unrelated entities in the same industries and determined that the tax rate is the discount rate is pre-tax, and they reflect current market assessments of time value of money and the risks specific to that assets, right, have not been appropriately adjusted in the forecast model. So again, very detailed kind of a procedure which the auditor performed to verify the appropriateness of discount rates. Work of expert, right? So in this scenario, the auditor reviewed the results of the management's expert by involving the firm's own valuation specialist. So the auditor has its own expert, and since it is a complicated matter, the auditor also chose to employ or engage its own valuation specialist, right? And when an auditor expert has been involved, the auditor also verified the relevance and reasonableness of the specialist findings. So they didn't just blindly rely on the work of an auditor's appointed expert, but they challenged and looked at the reasonableness of the findings of the auditor's expert. They also performed follow-up actions required for outstanding issues raised by the specialist and determined that the final deliverables, the clearance memorandum, and any other supporting documents of the specialist are included in the audit work papers. How did the auditor dealt with management bias? In this particular scenario, what the auditor did is that they identified management selection of revenue forecast, and they felt that it was a bit optimistic. So they found out that there was a bias, right? Now, to mitigate that, what they did is that they evaluated the reason for the selection with the management, and they were informed that this optimism was due to release of an updated market report subsequent to the management selection of assumption that indicated a higher rate of decline in the market, right? So again, the auditor would be concerned because the recent report of the industry painted a very different picture as compared to what management used. So based on this evaluation, and since the management was open to revising the selection of estimate, the auditor concluded that this is not an instance of management bias, or nor there was an intention to mislead. So possibly it was more of a timing issue when the auditor or the management prepared its own estimate. They didn't had this industry report, which painted a much more adverse picture. And since the management has corrected its own impairment model, then the auditor felt there was no bias and there was no intention to actually mislead the financial statements. And because of this, the auditor also concluded that this is not indicative of a fraud. Now, while the management's revision of the selection of a revenue forecast addressed the auditor's concern, the auditor was also concerned whether other fair value estimates prepared by the management contained optimistic assumptions and did not identify as such. So another important point which I want to highlight to all of you is that if you found out error in a particular estimate, you should look at where all these particular assumptions or data point have been used. If they have been used in different models or different accounting estimates, the auditor would need to verify whether those accounting estimates are also susceptible to the risk of material misstatement. Because at one instance, the management is agreeing to revise a model where there is an error, then obviously the other model should also naturally be revised by the management. So now, on an overall basis, what the auditor observed is that they have obtained sufficient appropriate audit evidence. Management selection of revenue forecast was deemed to be an indicative deficiency of internal controls, but these are not significant enough to call a material weakness, right? The auditor also considered the effect of this deficiency on the audit plan, and they concluded that they would no longer like to place reliance on review control, and they would need a higher substantive evidence where verifying the appropriateness of impairment charge. The auditor also considered the impact of this deficiency on the audit plan by evaluating its impact on other areas of management process. The auditor also obtained evidence from other controls over judgments taken in selection and data and to develop the significant assumptions. Uh, the auditor also performed substantive procedures, additional procedures, and based on the revenue forecast, they felt that overall there was a deficiency, but it was not a material misstatement, and accordingly, the estimates which the management made were possibly appropriate. Okay. Now, when we talked about accounting estimates, we also would like to reiterate the need for communication by the auditors to those charged with governance. Now, there is a specific auditing standard, SA 260, which lists out certain items which the auditor would mandatorily need to communicate with those charged with governance. But what we felt is that instead of listing out what is there in the standard, let's share certain experiences. So generally, what we have seen is that the auditor would communicate many things as far as the estimates are concerned to those charged with governance. Now, these communications are not only at the period end, this might happen progressively when the auditor audits. So, it might happen uh, more frequently at the interim date for high risk estimate, but that does not take away the fact that at the time of final reporting, they might also need to be reiterated to those charged with governance. Now, a couple of examples or a couple of experiences that we have seen as far as estimates are concerned is that the auditors would generally communicate estimation uncertainty, details about methods, data, and assumptions that the management has used. So, for example, the auditor would be communicating how management have made their estimates, what were the methods used, what were the data points that the management have used, whether they have involved any particular expert or not. That have been that would be looked at or communicated by the auditor. How appropriate and consistent these methods are, right? That might be an important discussion points between the auditor and the audit committee or those charged with governance. Whether in the auditor's view they are reasonable and whether these assumptions are reliable. That might be an important interaction between the auditor and those charged with governance. Now, as far as estimation uncertainty is concerned, we have generally seen the auditors communicating the areas of high uncertainty, for example, an ECL or a fair value or an impairment model. Uh, we have also seen auditors discussing the possible outcomes and sensitivity assumptions. Uh, the auditors would generally also discuss their assessment of disclosures, whether any information is obscured or whether the disclosures are appropriate, and they properly explain the estimation uncertainty or not. Management bias can also be an important item that is discussed between the audit committee or those charged with governance and the management. If there has been a pattern of optimism or conservatism that might be communicated to those charged with governance. Selective use of assumptions favoring a particular result, if those are a scenario of a bias that the auditor might like to communicate to those charged with governance. If there have been revision to prior period estimates without a proper rationale, that is certainly a key area for discussion between the auditors and the those charged with governance. Now, if there have been biases in other areas or other estimates on a multiplicity basis, whether what is the cumulative effect of bias on the financial statements, that might be an important discussion point between these two parties. Adequacy of disclosures, whether the disclosures are adequate and they're enabling the understanding of the particular estimate, might require a discussion, right? And how well they're aligned with the regulatory expectations, that might also be an important uh, area which those charged with governance might like to hear from the auditors. Yeah. So we are nearing the end, and we thought we will give you some takeaways, right? So, what the auditor would need to be mindful of when they are looking at accounting estimates. So, surely the auditor would need to be extra mindful because regulators consistently focus on audit of accounting estimates. The auditor might need to undertake a number of steps, and we have tried to put some of the key steps on the slides, and we thought we'll pick them up as a takeaway for all of you. The auditor should be confirming whether the chosen method is permitted as per applicable financial reporting framework. So, for example, the expected credit loss under Ind AS 109 is forward looking, and and it is weighed towards a probability of a particular outcome. Whether the assumptions and the models used by the management conform to that applicable framework or not, the auditor should definitely be mindful of. Another area which is often overlooked is brainstorming within the team. So what we have seen in practice is that it's a very powerful tool. It helps auditors to step back and challenge management assumptions before diving into detailed testing. So, brainstorming or engagement team level discussions, or the discussion between the management and the engagement quality reviewer, or valuation specialist, or any other specialist, might be a very fertile ground to look at possible risks. So, auditors should definitely be mindful, and they should be propagating these instances of brainstorming within the team. Now, there could be certain assumptions which are very critical and judgment sensitive, and they must be put under microscope, right? And what I mean by that is that they should be corroborated with an external third party evidence or industry matrix. For example, the auditor should pay very close attention to growth rates, as these often drive most of the value in a discounted cash flow model. Discounted cash flow model, or DCF, is a commonly used model, and one of the important assumption in that model is the growth rate. Now, there might be a particular growth rate which the entity might be using, but since it's a very, very critical assumption, this should be very carefully looked at by the auditor and dissected to verify its appropriateness. Right. So, as I said, they should be put under a microscope. What we meant by that is that it requires a very careful and a close evaluation. Now, one of the way the auditor might use to burst management bias is by actively monitoring optimism, unrealistic optimism, or excess or ultra conservatism. Right. So, if the management is being utterly or ultra conservative, that can only be identified if they are in constant touch with the management. They have to very actively monitor whether how management is now reacting to its to the fact that the auditor believes that they are ultra conservative or highly optimistic, right? So again, monitoring, continuous monitoring might be an area that the auditor might like to look at. Now, if there are specialists that have been involved, the auditor might also like to involve its own specialist, valuation specialist, or any other specialist, and their involvement is very uh, uh, critical, especially if you're dealing with highly complex estimates, right? I think we spoke of oil and gas, where we see a very, very special subject matter expert that is involved, or maybe an actuarial kind of activity in an insurance entity who are highly specialized in their approach. But again, what we like to reiterate is that only because an expert is involved, that doesn't mean the auditor is not responsible for the audit opinion. The auditor still continues to be responsible for the audit opinion. Yeah. Uh, Another important tool which we have, which the auditor have at its disposal, is to independently develop our own expectations. Right. So, for example, we might also look at our own point of estimate or a point of range. So we build our own crystal ball. The way we felt that management would develop its own estimate through a crystal ball, because they will look at futuristic assumptions, future information. Why shouldn't the auditor also do the same? So this approach also has its own pluses and minuses, and what we felt is that this approach could be one of the ways for the auditor to challenge management's estimation in a much more independent way, right? This also helps the auditor, or can help the auditor, in very easily identifying potential misstatements. Consistency in methods and assumption is a key principle, and if there are changes, that must be very well justified. Now, if there are inconsistent approaches, that can mask bias and can also mask potential statements, right? So this is, I think, consistency. You have heard me saying quite a few times, could be an important takeaway for you when we look at auditing of accounting estimates. Sensitivity analysis is also an important tool. Now, in a sensitivity analysis, the auditor might like to do a stress testing of key assumptions to see how small changes lead to big swings in estimates. That is again a very innovative way of checking how robust those audit conclusions are. So if a particular estimate is sensitive to a particular assumption, then one of the very good way is to do a stress testing, right? Lastly, I think subsequent events, as I said, they play a very vital role in evidencing auditing in high judgment areas. Considering subsequent events, the auditor should be verifying that the financial statements reflect the conditions that are existing as of the reporting date, and whether the disclosures that the management have based is reflective of the events and conditions that has happened subsequent to the balance sheet date, right? So quite a few takeaways we thought will bring to your attention, uh, and with this, I think this is what all I had to cover. I will hand it back to Vivek and ICI if there are any questions for me to consider.
Yes, sir. Sir, first of all, I would like to I would like to extend my sincere thanks to you, sir, for taking out the time from your busy schedule and sharing such a valuable insights on SA 540. I am also pleased to inform you that, sir, today we have joined by more than 1,000 members.
Okay.
And sir, we have also received some questions from the members during the session.
Sure.
So I would like to request you to kindly take these questions
Sure. Sure.
and address them.
Sure.
So I will read the questions on the behalf of participants, or
Sure.
also put the questions in chat box for your kind reference.
Sure. Sure.
So the first question is, how does a disruptive global environment magnify the subjectivity and volatility inherent in accounting estimates?
So I think if you would look at in today's environment, right, in certain jurisdictions, uh, particularly in the Western world, there are significant challenges in exports, right? I think last week there was certain data which the ministry released, which said that there was a 37% dip in exports. So if there is a difficulty in selling my product, then obviously there would be a challenge from the recoverability of my balances, right? So be it a disruption uh, in terms of tariffs, or be it a disruption on supply chain, they again squeeze the or pressurize the existing estimation process, right? So for example, if I would have been able to estimate a particular growth rate quite easily based on industry wide data, but since that industry itself is going through a turmoil, the availability of reliable data might be very, very difficult. So, because of this negative or adverse investment climate, or adverse business environment, they have a very omnipresent risk on every estimate, because nothing is certain. We don't know how in the very next day there might be much more adverse news coming from other markets. So again, because of the predictability or rather the lack of predictability of a reliable estimation of events, right? That I think would be more disruptive and would magnify the accounting estimates.
Okay. So the next question. one sec. So the next question is, what are the some qualitative factors that may cause a low value estimates to be materially significant?
I think that would be very, very fact specific. But if I could think of one example, which is laws and regulations, right? So, for example, there is a particular uh, litigation that we're having with a particular party. What we felt based on the case laws that were available till last year is that I might be exposed to a very, very lower amount of, of settlement. But if there is, an adverse or a very, very different perspective, which let's say a Supreme Court or a High Court would have taken, then that low value estimate might even become materially significant, right? So I know the question is about qualitative factors, but what I'm trying to say in general, that when you're talking about estimates, we would need to look at futuristic information, right? Qualitatively, if a particular estimate is prone to significant management bias, right? So for example, a warranty or a estimation of employee benefits, right, where there is a huge a kind of a disruption or a huge layoff, those factors might make a low value estimate to be materially significant.
Sir, can accounting estimates be made for interim financial statements prepared for the purpose of bank finance?
I think it is more of a laws and regulation question rather than auditing. It depends on what the agreements tells you. If the agreement would require you meaning the management to find out a particular number on an interim basis, then obviously you would need to make estimates. What we're talking about today is not how you should make an accounting estimate, because that is more of an accounting question. How What we are discussing today is that how we are auditing, right? But since there's a question, my advice to that person would be to look at the agreement that the bank would have given.
Sir, during the year end, the finance team finalized impairment calculation very late. How does time pressure affect professional skepticism and audit risk?
So let me give you an example. If I have to close my accounts on, let's say, 15th of every quarter, okay, uh, and if there is a impairment assessment that is being performed, you could imagine the level of rigor which the management and the auditor would be involving. To respond to this question very, very clearly, what I would only like to state is that impairment as a calculation involves a multiple permutation combinations. If those work is only done at the year end, okay, or very close to the audited sign off date, somebody would have taken 20 days to prepare an estimate, can't be expecting the auditor to finish that auditing in a day or two. So I think the more closer this complex estimation is towards the audit sign-off process, it is natural that the auditor would feel pressurized when looking at these estimates. But having said that, there are ways and means to deal with these issues. Probably a continuous monitoring or a continuous discussion with the management would help. But yes, I agree with this particular querist. This would require a significant exercise of professional skepticism.
And sir, the last question is, what are the key audit procedure and techniques to be applied while auditing accounting estimates relating to the leave encashment and gratuity liabilities?
I think the first step would be to look at the accounting, the look at the policy which the company has. In many cases, what we have seen is that we only talk about leave encashment, right? Which is basically my leave balances into the money which I will pay if the person encashes leave. The accounting standard, on the other hand, talks about compensated absences, which means that what would be the amount of compensation which the entity would pay if the employee would be availing those leaves, right? So that is an important criteria to look at. What is the leave policy? What is the gratuity policy? Generally, we will see that the gratuity valuation is capped to the amount permitted under the Income Tax Act, which is I think 20 odd lakhs. But if the policy itself is beyond 20 lakhs, that should first of all be considered. Second advice my would be that to look at the controls which the management has to extract the number of employees, the attrition rate, the salary increase rate, what is the controls the management would have put in? If the controls are robust, then obviously the outcome would be good. And lastly, at what point in time the data is shared with the actuary? Is it at the year end, or is it at the interim period? If there's a significant gap between the interim and the audit cutoff date, whether there are significant events that would require considerations. Right. So I think, Vivek, this would be my top three uh, response to these questions.
Yes. So thank you very much, sir, for addressing these queries and providing such comprehensive explanations. On the behalf of the Auditing and Assurance Standard Board, I once again express our sincere gratitude to you for your time and valuable contributions, sir. I would also like to thank all the participants for their participation and continued support. We also look forward to your presence in our upcoming sessions and webinars. So thank you, everyone. Thank you, sir.
Thank you, Vivek, and thank you, ICI, for having me.
Thank you.